Welcome back to Elite Code HS online class, subject accountancy, class 11. Today we will start basic accounting terms, chapter 1.2. The first term is transaction. The term transaction means an exchange or transfer of value either in the form of money or goods or services which are measured and expressed in the terms of money. For example, when goods are purchased in cash, then the seller supplies goods to the purchaser and the purchaser pays the money to the supplier for the value of goods supplied. Number 2. Event. What is happening around us regularly are basically events. There are two types of events. Number 1, financial events, and number 2, non-financial events. In accounting, only financial events are considered as transactions. It can be said that all transactions are events. However, all events may or may not be the transactions. This is because of the fact that non-financial events are not transactions. Next we have accounts. An account is a place where similar types of transaction and events which occur during a particular accounting period are summarized and accumulated. For example, furniture account is an example of one type of account. In this account, opening balance of furniture, furniture purchased, sale of furniture, as well as closing balance of furniture are disclosed. The two words debit and credit are used to explain the increase or decrease in any account. Number 4. Capital. In accounting, capital is meant to describe the total of money and other resources invested in business at its starting point. Next we have drawings. When a businessman is withdrawing cash or goods or any other assets from the business for his personal use, then it is termed as drawings in the field of accounting. For example, if the owner of a business is withdrawing rupees 3000 per month from the business for the maintenance of his own family, then the total drawing of the owner from the business will be 3000 multiplied by 12. Why 12? Because in a financial year or accounting period, there are 12 months. It can be from January to December, or the span can be from April to March. Therefore, the total drawings of that owner will be 36,000. Number 6. Liabilities. Liabilities are economic obligations of an enterprise that are recognized and measured in conformity with generally accepted accounting principles. For example, bank loan, debentures, creditors, bill payable, etc. Now, bank loan and debentures are long-term liabilities and creditors and bills payable are short-term liabilities. Next we have assets. Assets are economic resources of an enterprise that are recognized and measured in conformity with the generally accepted accounting principles. On the basis of generally accepted accounting principles, assets can be classified into two types. Number 1, current assets, and number 2, non-current assets. Current assets include closing stock, cash in hand, etc. And the non-current assets includes machinery, furniture, goodwill, etc. Number 8. Receipts. Inflow of cash for any reason may be called receipt. Sale of goods, interest, dividend, sale of assets, etc. may result in inflow of cash and hence considered receipts. Receipts may be of two classes. Number 1, capital receipts, and number 2, revenue receipts. Capital receipts includes sale proceeds of assets, life membership fees received, etc. Whereas revenue receipts includes sale of goods, interest received, etc. Next we have expenditure. Expenditure is incurred when any asset or service is acquired. Expenditure does not only mean cash flow. It may also mean outflow of other assets or increase in liabilities. Now expenditure can be classified in three types. Number 1, capital expenditure. Number 2, revenue expenditure. And number 3, deferred revenue expenditure. Purchasing of machinery is said to be a capital expenditure, whereas depreciation on assets or salary is a revenue expenditure. On the other hand, advertising campaign expense is referred as deferred revenue expenditure. Number 10, expense. Part of expenditure expiring in an accounting period represents expense. So we can say expense is the cost of use of things or services for the purpose of generating revenue. Now, instances of different types of expenses includes expenses relating to purchase of raw materials or goods, wages and salaries of the workers and employees, carriage for the purchase and sale of goods, and lastly, advertising expenses incurred for the purpose of selling of the goods. Number 11, income. Revenue or income is an inflow of assets which results in an increase in the owner's equity. Few instances of income are amount received on account of sales or amount receivable by selling the produced or purchased goods of the entity. Secondly, amount received on account of rent from house property owned by the entity. Lastly, amount received or receivable on account of interest on investment made by the entity. Number 12, profit. If the total income exceeds the total expense, then the surplus is termed as profit. Now the profit can be differentiated in two types. Number 1, gross profit, and number 2, net profit. If production cost or purchase cost of the products along with the expenses relating to purchase are deducted from the net sale proceeds of the product, the difference obtained is defined as gross profit. On the other hand, the excess of gross profit over the office and administration expense as well as selling and distribution expense are termed as net profit. Number 13, we have losses. The portion of expenses which cannot contribute for the generation of earnings of an entity is termed as loss. In short, any financial waste may be called as loss. For example, goods lost in transit due to an accident, goods destroyed due to a sudden fire in godown, any discount allowed, any bad debt, any depreciation, etc. are all examples of loss. Today up till this, in our next class we are going to discuss the remaining basic accounting terms.